What's up, everybody? In today's video, we're going to be discussing the book More Money Than God by Sebastian Mallaby. I really wanted to read this book because I read that other book, The Man Who Solved the Market by Gregory Zuckerman, and it was about Jim Simons, who was a quant trader. I really like books about financial markets. I'm also into financial independence, which I've spoken about on here, and I think learning about the stock market and the economy is a good place to start. And that's one thing I'll say about this book. It's not only about hedge funds, which is mainly about, is it's about understanding the economy and financial markets and how hedge funds play a role, but also how government institutions also play a role. And I first learned about this book from Tim Ferriss. He brought it up in he brought it up in one of his social media accounts, and then so I saw it at a bookstore and I bought it then, but I hadn't finished it, and I recently wanted to finish it after I read that book about Jim Simons. And this book is really amazing. It gives such a thorough overview of hedge funds, where they came from, and probably where they're going. And it took me a while to understand how this book was written because it's very dense information. It gives you a lot of information of like how hedge funds are started, and it starts with A.W. Jones. And it takes a while for you to figure out that what the author's doing is going along a timeline from basically the first hedge fund, which is A.W. Jones, into all hedge funds. He's trying to tell the story of the largest hedge funds in order. And the main hedge fund managers he focuses on in here are Michael Steinhardt, Paul Tudor Jones, George Soros, and Julian Robertson. And basically all the other hedge fund managers in here are branched off from those hedge fund managers. I really like this book because he didn't provide just like a general overview of each fund manager. He went into detail in all of their biggest trades, which was very informative. But he also went into how those trades affected governments, economies, and society, which I thought was really good. And a central theme in this book is government regulation and should hedge funds be regulated. I would say that's the central theme to the book. And reading the book, I thought the conclusion at the end was going to be that hedge funds should be regulated. But spoiler alert, it isn't. The author shows that hedge funds haven't been regulated very much over their lifetimes. And yet many of them have failed over time, like thousands upon thousands have failed. And yet it hasn't destroyed the markets. They weren't the ones that had to get bailed out during the financial crisis. It was other institutions like banks that had to get bailed out. But there are some things in this book that are very foreboding about the current environment. I'm filming this during COVID-19, and I think some of the things mentioned in this book could have huge implications now, because what this book talks a lot about is about leverage. And anytime a hedge fund blows up, it's because of leverage. They're over leveraged and they're in a market where there's too many other people that are doing the same thing. And this happens to hedge funds time and time again. And one of the main reasons it happens to hedge funds is because interest rates get held artificially low, which is the environment we're currently in now. And then with that, banks and hedge funds leverage up, and they all tend to follow each other. And so these trades become extremely over leveraged and overcrowded, and bad things are going to happen. I think that's what's going to happen in the economy now, because the Fed has lowered interest rates to almost zero. And what's bound to happen here, as the stock market has been going up recently, is that there's asset bubbles that the Fed creates, and those blow up. And that's something that's shown in this book over and over again, that the dot-com bubble, a lot of companies use leverage. There was tons of bond bubbles as well, where hedge funds would try and get in and do some arbitrage. They would borrow short and then buy long. But then once one hedge fund was doing really well, then other hedge funds would follow suit, and the bubbles would create. And then once the bubbles burst and people try and get out, there was nobody to sell to because they're all in the same trade. And I think that's something that might happen again now, because the Fed has kept interest rates so low. So I'm worried about that, but I'm also worried about the future as well, but as it relates to the Federal Reserve and other central banks, because what this book also shows is that it's not just the Federal Reserve in the US, but central banks around the world. When they're slow to change or they don't understand what they're doing, then it leads to these huge asset bubbles that just blow things up. And another case of this is, like in the book, is George Soros and his bet against the sterling. He was basically betting against central banks in Germany and in the UK, In that case, there was a certain scenario where Germany wouldn't move their interest rate when UK wanted them to, and then the UK had to devalue their currency, and George Soros saw that coming. And he saw it coming because a lot of these people were bureaucrats and they didn't realize what was coming. They didn't realize what had to get done. He saw it ahead of time in UK, and he also saw it in another trade when he bet against the Thai baht, and he forced that currency to go down. And this is probably where a lot of conspiracy theories come from for George Soros, because he forced these governments to devalue their currency, and then he tried to become a statesman after that. And this book also talks about that. He got involved in Russian politics and lent to Russian people because he believed after the Cold War that the country was going to get rebuilt and that he was going to be central to that. And that was one of his losing trades, was betting on Russia and betting on their bonds and things like that. But there's good information in here about George Soros and his protege, which people don't probably know, which is Stanley Druckenmiller. It talks about that a lot. It talks about their relationship. There's a huge focus on this book about George Soros. And that's valid because George Soros probably made the hedge fund industry very popular. He did become a statesman. He was involved in politics. But now there's a bunch of conspiracy theories about him. But it's probably because he is so involved in so many things and he does have a lot of money. But he also stepped away from investment management and came back again in the financial crisis. So it's very interesting to learn more about him and his hedge funds. And another central character is Paul Tudor Jones. And he was like more of an intuitive fund manager. Like he would study charts and things, where other hedge fund managers were called multi-strategy hedge funds, or they were macro traders, which means they traded on currencies, equities, bonds, everything. And then later on, there was people that were event-driven hedge funds, which means they would wait for bankruptcies or mergers to happen. So it's kind of cool to learn about all the different strategies of hedge funds and how they change over time, because somebody always thinks they have an idea that's different than the next fund manager. And if you have an idea that's different than another hedge fund manager, it's easier for you to pitch those ideas. Even though there's always somebody coming up with a new idea, once somebody comes up with a new idea, here comes another guy to copy him. And that happens time and time again. And then, like I said before, these hedge funds leverage up, get into the same trades, create a bubble, and then it gets things changing. So things are constantly changing in the financial markets because of this. At the end of the day, banks and hedge funds will always leverage up as long as interest rates are low. Another thing that was kind of astonishing was the crashes in the book. There's so many hedge funds that went under. Like long-term capital management is one of the central ones they talk about in this book. And a lot of those destructions of hedge funds highlighted the psychology of trading to me, because these people are managing billions of dollars. They become billionaires, millionaires, and they think they're invincible. And that narrative in financial markets happens over and over again. And it just shows that you have to be risk averse. But even long-term capital management had like a really good risk model. The thing is that they thought they were so smart because it was a bunch of professors. But what they were betting on is the markets wouldn't be volatile over the long term. And they're right, markets aren't volatile over the long term. But in the short term, they can be very volatile because people's psychology, people panic, people get into the same thing, and they all try to get out at the same time. So it's just interesting to me to learn about the psychology of trading. There's a lot of gamblers' mindset where the people bet large sums of money and they bet big on certain areas, and it just blows up. But it's just amazing to me that people can be on the top of the world. You've achieved the pinnacle of success. You're running a hedge fund, and then in a matter of months or a year, you can be out of business. And another story in here that I really liked was the one about John Paulson. He was a hedge fund manager who bet against the subprime mortgages, and he made $1.25 billion doing that. And that sounded really interesting. And I'm going to read a book about that called The Greatest Trade Ever. That's one of the books that I'm going to read after this book. Another book that I'm reading is Fortune's Formula. And that book is about Edward Thorpe, who is another hedge fund manager, and the people that influenced him, like Claude Shannon, and a lot of the statistical and mathematical calculations that are used in hedge funds or portfolio theory and financial management. So I'm reading that as well. And I hope to just get more insights on the market from those books. And this book also mentions Jim Simons, who founded Renaissance Technologies and was in the book The Man Who Solved the Market. I thought I already knew a lot about it since I read that book, but this book does a little bit better of summarizing Renaissance technology's success. And it says the Renaissance technology is obviously a quant fund, but there's a lot of quant funds mentioned in this book. But the author says the reason Renaissance technology is different is because they hired cryptographers and they hired voice translation programmers. And the thing about cryptographers and voice translation experts is they're decoding hidden messages or looking for messages in data that's very hard to get through. So that's why Renaissance Technologies is the most successful hedge fund in history, is because they hire these people that aren't necessarily from the financial industry, whereas most quant funds and most hedge funds hire financial experts and other people in finance. And that's what the book Fortune's Formula is about. It's a little bit more about these formulas that can be used, these mathematical formulas that can be used to help you manage your portfolio. And there's a bunch of different methods and calculations in that book to help you manage your portfolio. So I would recommend this book to anybody that's interested in financial markets, interested in learning about hedge fund managers, and about hedge fund strategies, and whether or not hedge funds should be regulated. And there's tons of information in here. There's tons of information in the bibliography in case you want to research more about it. So make sure to like this video if you enjoy the content and subscribe to this channel. Thanks for watching.